Okay, we're going to get started. Welcome to lending. We're talking about lending today and the changes that have happened. There's lots of good room for Q&A as well, so I just want to go over with y'all the format. The audience that we have on this today are potential homeowners, buyers that have more than likely been pre-approved, maybe not, and also realtors. We also sent the invite to realtors so they can pass on the information to their buyers. So I am recording this. So I will, all of the attendees, you had to provide an email to register. So I will make sure and send this presentation and the recording to all of the attendees. So today's Wednesday, so you'll have it by tomorrow at the latest on your email, okay? So just a couple of housekeeping things. We do have a chat button. Please raise your hand, chat, if you have a question. We do have everyone muted for just the quality of the call. So that being said, what we're going to go over today is we're going to go over some history of why and how we are where we are. A lot of people that don't deal with rates every day, how would you understand that rates aren't zero like the Fed rate happened? So a lot of people, and probably why you're on this call today, is because you're wondering, like, what the heck is going on? So the news is really consumed, of course, with talking about COVID and all of the stay-at-home orders and all that. They're not really talking about mortgages. So behind the scenes, there's a little chaotic world that's been happening. Things are starting to calm down, but that's what we're going to talk about today. So again, I'm keeping an eye on the chat. Raise your hand if you have a question, and I will definitely answer that question as well. Okay. All right. So here we go. Just a little bit about myself. Jennifer Hernandez. I've been lending for 24 years. It'll be 25 years this September. And I've originated almost 4,000 loans. I think this year I will actually surpass that 4,000 mark. So super exciting. I love to help people get into homes, and I'll just do it till I retire. I'll probably work for about 10 more years. I'm 49 now, so I'll probably work for about 10 more years, at least full time. So we'll see. So I'm committed to helping people. I'm 100% referrals. So referred by past clients, referred by realtors. That's how we get our business. And we just love to educate people so they can make the best decision for them. So that's how I roll. All right. The next thing we're going to go over. So just kind of an overview. This will be worse than the 2008 financial, crisis that really caused, all around the country, a lot of chaos. This is similar in that it affects the whole country. It's not just a pocket of an area. So I have seen, I guess in my 25-year career since 95, if we go backwards, I've seen, the 2008. Also, actually, Harvey, if you're in Houston, then Harvey obviously happened. Houston did recover from that pretty quickly when you think about it. Houston is super resilient, a great market because we have low price points. But 08, the market here in Houston did go down a little bit. It did rebound pretty quickly as well, though. We didn't see values down for more than about a year. They did rebound pretty nicely. After 08, and then going backwards, we had the dot-com, era, that early 03, 02, 03 period. And apparently people have told me that when I got in the business in 95, that the market was super bad, but I don't remember. I was too new to know anything. And I was just like hungry to make it happen. So I didn't even know any better, but apparently in 95 was a big chaotic mess as well. So anyway, there's some misunderstanding. I'm here to just kind of maybe diffuse some myths and just tell y'all exactly why things are happening the way they are. So really the main thing that's happened is that there's a major liquidity issue with banks right now. Okay, so we're going to go through a little bit of the history of that. And as we go through this, the dates in red, I kind of have some dates, and you're going to see that most of these dates of how things happened are within like a 2-week period. So it's been pretty chaotic. So first, just really quick, how a mortgage works. And if you already know this, it's going to be a repeat, but this is just how the mortgage machine works. Okay. you go to a mortgage originator. Let's say you come to me for a mortgage, and then once the loan is closed, we are going to sell the servicing. We would either service it, which we don't, or we will sell or transfer the servicing to a larger machine. Okay, like we sell loans at Legacy to like Wells and PennyMac and AmeriHome. There's about a dozen of them. Okay, let's say we sell it to PennyMac. PennyMac, they don't actually own the loan. They're just maintaining the loan, because really the owner of the loan is probably Fannie Mae or Freddie Mac. If it's an FHA loan, the owner of that loan is called Ginnie Mae. And these are these government sponsored entities that really make all this liquidity happen. You would never pay your loan to Freddie Mac, Fannie Mae, or Ginnie Mae ever. You would always pay it to this servicer that, just think of it as just like a holding ground. It's just kind of a cesspool of where you make your payments. Okay, so these lenders, so we originate the loan, we sell the loan to PennyMac, let's say, and then PennyMac, they also have to make payments on this loan. Okay, so they have obligations to a larger pool of money that they have to make. So you pay your principal and interest to them, and that interest is helping them cover interest that they have on the money that they lent you, okay, or that they indirectly lent to you. Okay, so they're the servicer of the loan. So I wanted to explain that. So these loans are then bundled up and sold. So let's say I'm a servicer, or let's say I'm a PennyMac or a Wells Fargo or a B of A, whoever. I'm going to bundle millions of dollars of loans together, and I'm going to securitize them. That's how a mortgage-backed security is created. And so this part is super important, because it's going to lead in slides later on of why lending right now is constricting. So for certain programs, okay? Mortgage-backed securities is a bundle. Just think of it as a huge cloud of loans that meet a certain criteria, like average coupon or interest rate is 3.5%, average credit score is 720. Like the bundle will have criteria, but there's thousands of loans in this big bundle. So there's just an average that's given. There may be a few loans in there that are really at like 660 or 670, but this average. And so this mortgage-backed security, when these big companies are trading this mortgage-backed security, they're like, hey, I've got this bundle of loans with an average interest rate of this and an average credit score of this. Do you want it? And the investors on Wall Street, you know, the big hedge funds and insurance companies and the huge investors that are investing in these safe haven, this cloud that they want to get a return on monthly, they're like, yeah, average 720 score, I'm going to buy into that. I believe that that is going to perform. And so that's how it works. That's how the mortgage market works. And so the reason this is important is because now this cloud of this average coupon with this average credit score has a lot of holes in it. It's like a holes in the ozone layer, okay? And that's what's happening. So we're going to go through that in a minute. But I hope that this makes sense. And again, y'all are going to get this presentation for a lot of this real detailed writing, but hopefully you'll ask questions too, if I can answer any questions. All right, so then the reason rates became so low is COVID. So COVID happened, okay, so the mortgage market was just trailing along, rates were around 4. This is back in January, February. And so then COVID started to wheeze into and weave over America. In fact, I even remember that I was at a conference in Vegas in February 22nd. I remember because it was right before my birthday. And I kept hearing, and I was like, God, I wonder if it's going to come over from China and come over to the US. Like, I just wasn't really thinking about it. But that was right at the end of February. I remember, because I remember where I was. So that started to happen, and it started to seep into our language and society in late February, early May. So at that time, when COVID started to hop over to the US, interest rates took a complete nosedive. Like they went super down, super fast. And that is when everyone was like refunding. They're like, well, I want a low rate. I want to refi, because rates, 30-year fix was around 3.25, probably without any points, kind of around that time. So that what happened is we saw rates super low in a super short period of time, which in my 25-year history, that has only happened, oh gosh, that it's really gone down like that. I think I've maybe seen it like one or two, like at least 2 times, 2 to 3 times maybe in 25 years, that it's just changed so super fast. Okay. So that's not very often. So this all happened around March 7th, and mortgage-backed securities became super attractive because of this fear in the market. Investors started to be fearful, and they take money out of the stock market and they put it in the safe haven of the bonds. Because remember, the bonds are these, remember I called them clouds. They're these clouds of security notes, like, oh, this average coupon of, this average rate of 3.5 and this average credit score. Well, I have faith that that cloud is going to perform. And so I'd rather get 3.5% than be in the market at negative 15% or whatever it is, right? So fear drives rates lower historically. So that's what happened, okay? So then, if you can see on this graph that's on the page, refinance activity within a few days spiked up. Okay, so by March 9th, rates fell to their lowest point. And then between March 9th and March 17th, something very, very important happened. Lenders, I don't know how to say this lightly, they were super overwhelmed, they were buried. And so think of half of the mortgages. The mortgage market is per year, $1.5 to $2 trillion. So the amount of mortgages that are on the books at any one given time is over, it's over 5 trillion. So if half of the mortgages become available to refi in a week's period of time, and lenders, I had days that I couldn't even lock a loan because the system was so clogged up because of the activity. There's a software we use, it's kind of a national, lots of lenders use it. It was so clogged up, it took me so long to get in there because there was so much traffic. And so locking, like you just couldn't keep up because everyone wanted some. Everyone wanted some of the low rates, right? So lenders became super overwhelmed. And then they had liquidity issues because then they were starting to freak out because lenders were like, okay, wait a minute. We have all these monthly these monthly payments that we're expecting to have at this, and we've made our financial decisions based on this income that's going to come in. And then now it's all going to go away. And so what you're thinking as a consumer is you're thinking, well, it's business for them. It's probably going to come back to them anyway. What does it matter? It matters. And so, loans that they were expecting to have 5 to 7 years, because that's kind of the average time that people have mortgages anywhere from 5 to 8 years on average before they turn another one. It was sometimes even 6 months. And so early payoff is a huge, huge, huge cost for lenders. So they were having early payoff or potential early payoff. And also they had so much volume that it was like operational Armageddon. So the lenders and most of this, really all lenders across the board were at capacity. I mean, myself included. I remember there were nights I just wouldn't even sleep. I just couldn't even get out of email. It was just, and all these loans that were in the system were trying to close in the same amount of time that it takes them to close in a whole year. So the amount of volume that normally mortgage industry sees in a year was being crammed into like a 30-day period. So there's not enough people, there's not enough trained people, it was just pure chaos. It buckled everything. So what the lenders did overnight, March 17th, is they just rose them all. They must have all been on secret phone calls at night. You know, we have some leaders in the market that kind of set the tone, like Chase and Wells, and some of the bigger mortgage entities kind of lead the way. So overnight, I remember waking up and it was around March 17th, and the rates went up 1.5% overnight. And the consumer was like, oh yeah, hey, I want that really low rate. And I'm like, it's gone. And they're like, what? You know, y'all just didn't understand. Like, well, what are you talking about, 4.7? So what happened is the market froze. There were certain days where we just couldn't even lock loans. There were, I think the largest change in a day of rates for me was about 10 to 12 times. And usually rates will change 2 times during the day. Sometimes we'll go days and there's no change. But on average, let's say 2 changes a day. So to go to 10 to 12, I would be talking to a client about a loan on the phone, and I would just take a bathroom break, and I would come back. I would get in my computer to, you know, lock things in, and the rates had already frozen and were suspended and were changed. So just giving you a little bit of a peek behind the curtain of what we go through. That's how fast things were moving. So a lot of companies were just like, we're just not going to lock loans, because if we tell a client that they're getting, you know, 4.5, and then within 10 minutes, it's back up to 4.7, we're going to lose our shirt. We're going to lose confidence from people. We're going to lose money. We're going to lose all these different things. So a lot of other problems, started to happen. Okay. So I'm just giving you kind of a peek behind the curtain of what happened between March 9th and March 17th. So lenders, it didn't matter what was going on behind the scenes. I think during all this time, the Fed had even lowered the overnight Fed rate to 0, which you'll see in a minute, that is not the mortgage rates. Okay, so that really just didn't matter. The mortgage industry had all other things that they were worrying about that had nothing to do with that. Okay. Remember, we've got questions. If anyone has a question, please ask. We do have one question actually that we will go. Is it hard to get a jumbo loan? Yes, Judy, it is. And so I am going to go through that. I've got a couple slides to go, and I am going to go to that. So that's a great question. Okay, so mortgage shortage, basically mortgages were super short for a while. And they still are, but it's getting better. So there was about a 2-week period where things were super, super, super volatile. Okay. Now we're going to go to, this is again, I already really went through this, but where I put the yellow on here is why, the secondary market secondary market is where these loans are sold, those MBS securities. The 30-year fixed mortgages that people had even locked back in January and February at 3.5 or 3.2, they're now having to deliver as if they're 4.5. And so lenders started to lose a ton of money. I mean, lenders all over the country were losing money, and some lenders have gone out of business. So what happened is the government came in and they saved the day. They came in and they said on March 19th, they said, hey, the mortgage industry is in a complete chaos. We're gonna influx billions of dollars to buy these mortgage-backed securities because no one else is buying them. There was no market. Investment funds, hedge funds, no one wanted to buy these mortgage-backed securities. And so they influxed and said, okay, we, the government, we're gonna basically buy our own debt, is what happened. And that's why the mortgage rates started to come down. The mortgage rates did not start to come down because of the Fed rate to 0. The Fed rate to 0 was to solve the liquidity issue of how banks borrow money overnight when they're making sales and purchases of things that investments that they do. Okay, so my cousin works at Bank of New York Mellon, and she's the one. Bank of New York Mellon helps alleviate the burn rate between overnight lending, where they make these trades at night in other countries across the world, and then they have to, it's like covering a check back in the old days. It's so you don't bounce a check. Okay, that's what that over Fed rate 0 is. It's not the mortgage lending rate. So when the government said that they're going to alleviate the mortgage market with the $700 billion and buy these mortgage-backed securities, that's when investors started to calm down, and rates have trickled down. Okay, so things are a lot calmer. Okay, and that happened on March 20th. Okay, so this is just kind of a repeat. You can read this when you get the slides, but basically rates dropped again due to the market being infused with the money. Okay, so mortgage servicers have taken it hard. I'm about to go, hang in there with me. I'm about to go over the products that have changed. I'm sure there's going to be a lot of questions. I just felt like this history was a little bit important so that people understand why the rug is being pulled out under some borrowers, okay? Because COVID is still very much going on, and we're going to be dealing with this the rest of the year, I have a feeling. Now these servicers of loans feel a little bit more comfortable making loans because they know that they're getting the influx of money from the Fed. Okay, so that's if I'm a PennyMac or a Wells Fargo, I'm like, hey, I'm not going to make loans unless I know that I have some security on them. So now that goes to the next reason of why guidelines are changing. So this is the really, really, really important part. Lenders are concerned that they're going to make a mortgage for you today and that you're going to be unemployed tomorrow. We still have not seen the impact of all of the layoffs, especially being in Houston. Oil, unfortunately, is just being hammered. I can't even believe what's been going on the last couple of days. And so we're still going to be dealing with this months down the line. And so as a lender, lenders are like, hey, how do we mitigate our risk? How do we ensure that for the most possible, we aren't going to get caught holding the short stick? Okay. And so this is the part that you've probably been waiting for, which is what programs, as of right now, these are the programs that have changed. Any kind of hybrid I didn't put this on here, but the hybrid programs that were out there, like a bank statement program or anything that's kind of out of the ordinary, it's gone. Those lenders have been like, nope, we're not doing anything risky, weird, out of the ordinary. Now, jumbo loans, Judy had a question earlier. Yes, they are affected. Jumbo loans are called jumbo because they're jumbo, they're large. And those are loans above $510,401 is where those start. So any loan above that, loan amount, not purchase price, any loan amount above that is considered jumbo. And most lenders have exited out of that business right now. It'll come back, but it's temporarily suspended. If I'm a lender and I'm going to lose my shirt on a loan because of someone going into forbearance or not paying or losing their job or going into default, I'd rather it's on a $200,000 loan than a $700,000 loan. So that just makes common sense, right? So a lot of lenders have said, no, we're just not going to deal with jumbos at all. So what I'm encouraging people to do, so when people call me about these kind of loans, and I even told the client yesterday, we've been following him for 2 years. He's been trying to buy a property for 2 years, and it broke my heart to have to tell him, you're about to be under contract, I can't help you. He's a jumbo loan amount. And so I guided him. I said, hey, look at some of the local regional banks, like in Houston, it's like Cadence, Amegy, Independent Bank. So those banks will fill the gap, but you should expect that you'll have to put definitely 20% down, definitely have pristine credit, more reserves will probably be required. So we try to point people in the right direction whenever we can. The next product that's been hit pretty hard is all the government loans. So that includes FHA, VA, USDA. FHA stands for Federal Housing Administration. Max loan in our area is $331,000 on that. VA can be any loan amount, you know, you have to be a veteran. And then USDA are the rural loans where you can do 100% loan, but that's in the outlying rural areas, so it doesn't really apply in the city and suburbs. Used to be able to go down to 580 credit on those programs, and now almost every lender is at 640. We're at 640. There are some lenders that are at 620. I don't, no one is below 620. FHA will accept a 580 loan, but no one's originating them. So what happens is you've got FHA up here and they have their guidelines, but if there's no one willing to take the risk, if there's no lenders willing to take the risk on those borrowers, then no one's delivering those loans to FHA. So that's what's happened, is that the brakes have just come on because it's been identified, whether it's fair or not, it's been identified through statistical, historical data that those loans foreclose quicker. Those clients usually have lower credit profiles and you know, no reserves. They're tighter on their money. They're not as affluent with their savings. And so they'll foreclose quicker if they hit hard times. If one person in the household loses their job, they're more likely to foreclose or go into forbearance. So lenders right now are worried, they're fearful that they're going to make a loan today and close today, and that tomorrow that client will go and file for forbearance and never make a first payment. And if they do that, that lender, so we, Legacy, and then when we sell it to PennyMac, for example, we still have to pay money on that loan. We still have cost every month that we owe somebody. Just know that everybody has someone that they owe money to. It's like it's a continuing cycle. The money keeps flowing somewhere, and it always keeps going uphill. So someone, that lender, whoever your lender is, or if you have a current loan now, someone still has to foot the bill even when the loan is in forbearance. Okay, just like if you're a landlord and your tenants can't pay rent, you still have to pay your mortgage, right? It's the same concept, okay? So I'm gonna stop for a second before I go to conventional and DPA, down payment assistance, because we do have a couple of questions. So I'm going to answer those right now. Oh, FHA loans, Luz. I just went over FHA loans. If I didn't answer your question, let me know. Another question, Steve, Jennifer, if you are a vet with 90% disability, do you know how much a buyer will have to pay on this home? Yeah, the rates right now are about 3.5% on, if that was your question about interest rate. So government loans are happening, they're just happening with a higher credit score. Okay, so if that didn't answer your question, please let me know. Karen, on the new credit score requirements, is the down payment higher now or it remains the same? So that's a fantastic question. So the down payment is the same. So FHA, we're talking about FHA, you can have a 3.5% down payment, and your debt to income ratio, at least as of right now, it hasn't changed, can go up to 55%, which is super generous. Between your housing debt and your total debt can be 55%, which means for every dollar you earn, 55% goes to debt service. That's super generous. I anticipate, honestly, that might go down to 50, but it hasn't happened yet as of right now. So that was a great question. On conventional, well, first let me finish FHA and then I'm going to go to conventional. So Jaime had a question about additional guidelines for FHA. Right now, only the credit score requirement has changed. That is the only thing that has changed. Just based on experience, I anticipate the debt to income to possibly change, but again, it hasn't happened yet. So we're still pre-qualifying people up to, you know, 54.99% debt to income ratio, if that's what they have. But that's a danger zone, to be honest with you. If that changes, we'll have to make a lot of phone calls. Another person had a question about conventional. So on conventional, the down payment, the minimum down payment for a first-time buyer is 3%. That's still intact, not a problem. What we have seen with conventional loans, every loan that we do, we have to run through an automated underwriting system. And this has been years that we've had to do that. So what's happened behind the scenes, and it happened silently, there wasn't a big memo, that it just said, hey, we're tweaking and tightening the guidelines. So what has happened, and we've noticed through experience, is that 45% debt to income ratio is really where the loans are being required to be below that debt. So in the past, if I had a client putting 30, 40% down, they could go up to 50% debt to income ratio. Not anymore. Even if they have a big down payment, lots of equity, the system is not liking the higher debt to income above 45. And in addition, if you're a first-time home buyer, it's probably going to be limited to 40 or 43% is what we're finding. Again, there's no established maximum. It's the threshold of what the automated system is accepting. So it favors borrowers that have higher credit and have more reserves. So reserves is when let's say you need $15,000 to close. And reserves means how much money after your $15,000 do you have in reserve? So let's say your payment's $2,000 a month. 6 months reserves would be $2,000 a month payment times 6 months. That's $12,000. So the more reserves you have, the more favorable the automated underwriting system is on that. So I hope that makes sense. Let's see. I have another. Thanks, Vet. Steve, if I didn't answer your question about the vet, let me know. I think that I answered it, but I saw that you asked it again. So just make sure if you could let me know. I've got another question from Vicky. So no FHAs being written, that is incorrect. They are being underwritten. Just they have to have a higher credit score than before. So FHA, VA, USDA loans are all being underwritten as of right now. A couple of weeks ago, the market was kind of at a standstill and they kind of weren't, but we're already past that. So I'm talking about right now. So hopefully that answers your question. Got it. Okay, I think I'm okay on answers right now. So the last thing that I want to address is down payment assistance. So down payment assistance in the state of Texas, there are 3 main down payment assistance through the community housing of community development. That's TDHCA, TSAC. These are acronyms. Okay, there's one that's for teachers and fire, Home for Heroes. There's My First Texas Home. So there's TDHCA, TSAC, and SEF. So those are the 3 acronyms. So a few weeks ago, the states have not stopped those programs. The lenders have stopped offering those programs because of the fear of the forbearance. Lenders are fearful, and lenders all over the country, or definitely in Texas and Houston, are saying, hey, the states are still offering these programs. However, we are fearful because if we make a loan and the client doesn't make the first payment because they've applied for forbearance, we can't sell that loan to the market. It's frozen. And so lenders will lose their shirts everywhere. And when lenders start losing a ton of money, it's going to trickle down, and future homeowners are going to pay the brunt by lenders having to increase their cost is what's going to happen. So we're trying to mitigate risk. So Legacy actually just yesterday announced we will not do down payment assistance. I'm pointing clients to credit unions. So if you are a realtor on this call and you get friendly with some credit unions, 1 or 2 that might be offering down payment assistance for your borrowers, as far as I know, some of them might still be doing that, some might not. What's happening is everything is very lender specific. And I can just tell you my integrity is that when you call me and I can't do a transaction, a buyer's program, I will tell you, and I will help you. I will direct you, hopefully, to someone that can help. I'm about to transfer a loan today to a good friend in Dallas that will take care of my clients. Their credit score is below 640, so I can't help them on FHA. So I'm helping them, you know, get in the right place. Okay, so hopefully the lenders will continue to do that. We're all just here to help each other out. Okay, I do have some more questions. So that's down payment assistance is very scarce. Okay. Credit unions that I recommend, the question is for down payment assistance, any credit unions that you recommend? Not necessarily. I'm trying to make a side list of the ones that are offering it. I don't have that yet, but TDHCU is usually popular. First Choice Credit Union. I would just look online and look at credit unions and just kind of start calling. I don't have any specific names of any, but I am trying to maybe get a list of a few so that I can point people in the right direction. So not yet. Okay. Let me make sure that I've got any other questions. I think I've answered all of the questions so far, but keep them coming. We've got a couple more slides. Okay. So things continue to change. I do want to let you know, if you are a buyer and you're potentially going to buy something, it is still a great time to buy a house. I'm actually super busy with new requests. So there's two groups of people out there. There's people that are nervous, and they're nervous about their job, and they're on hold. They're either on hold selling or they're on hold buying, and that's totally understandable. And then there's another group of people that are like, nope, my lease is expiring, or I have to move because I have a larger family, or whatever the reason. There's also another group of people that know things are going to get back to normal. You still have to live somewhere, and rates are back to being good. I mean, rates are in the mid threes, so rates are good. I do feel that I probably think, and realtors, the realtors on can comment yes, no, maybe what they think, but I think that the summer we're going to see some softer prices. I don't think that the appraised values are going to take a nosedive, but I will tell you from experience, because, you know, I lend all over the city, all price ranges. You know, I mean, my team closes 20 to 25 loans a month, so I have a pretty good litmus test of experience monthly currently. We are still seeing multiple offers below let's say below 300,000. So I have several, actually I had one this morning they're putting in a house offer for 400, and it's multiple offers already. So the lower price ranges, if you're in the lower price point, you've got to get pre-approved early. Call me to update your letter if we've pre-approved you and haven't talked to you in a few months. We're definitely trying to make those outbound calls as well. Get your pre-approval letter updated to make sure that things have not changed for you. Encourage your clients, if you're a realtor, to do the same thing. And secondly, be prepared, because there are still backup offers out there. So I think the higher price points are the ones that will probably suffer a little bit, especially as oil, unfortunately, is unfolding. Those are the price ranges that we see that stall out the quickest, are the larger price points. So it just depends on what price point you happen to be in. I do have another question, and then I'm going to go to another slide. So Sandy, good to see you. That has disability, how much are taxes discounted on the home? I don't know for sure, but I know that they are discounted. You'll have to go probably to the county website, and it's going to be there. So I would go to HCAD and I would look it up. I know that 100% disability is no taxes, but there is a slight discount when there's 90% disability, but I'm not sure. It's not 100%, I can tell you that. So you'll just have to go to different counties, have different rules on that. Okay, I hope that helps you. Okay, so moving on, things are calming down. We're still in the storm of COVID, but the storm of lending, things are evening out to where lenders have identified the loans that they will do and the loans that they won't do. That sea is kind of parting to where you're either on this side or this side. So I will tell you, if you have low credit, we've got to work to get it up. myfico.com is the very best website to talk about credit and credit education. I like to refer people there. Cash reserves is king, and cash is king. And also for the realtors on the call, or even for the buyers and sellers, I would super expect if there was going to be an increase in people asking for closing costs credit, especially in the lower price ranges, because the down payment assistance is going away for a lot of lenders. And there's going to be people that need help to get them over the edge to buy a house. So I think there's going to be a surge in asking for closing cost credit. So make sure sellers are aware of that, because I think it's going to be a reality to try to make some deals happen. Okay. I do have a couple other questions. Let's see. Credit score for the down payment assistant programs. Oh, that's a great question. The ones, well, we're not doing down payment assistance right now, but for the ones that are still doing it, it's 620. However, a lot of them are going to 660. So just because the state allows 620 doesn't mean that the lenders are going to allow it. So the lenders have the right to make their own, what we call overlays. So I just think as a golden rule, you've got to make sure that your buyers, or if you're a buyer, make sure that you're in the best situation possible. Getting to 660 is the key, because that kind of seems to where the cards are falling, to where 660 is the determining credit score of kind of getting people over the hump, is what I'm seeing. Okay, so I hope that answered your question. Do I foresee, another question, do I foresee a large increase in foreclosures and short sales? Yes. Yeah, I do. I do see that. And that's probably not going to happen. I mean, if you think about it, foreclosures, they have to be 3 or 4 months behind. So I think the fall is where that's going to hit. Once again, I just do want to remind y'all, what I saw when we dug out of Harvey is, if it wasn't for the investor market, I can just tell you our recovery would have been a lot slower. Houston has a really strong investor market. I know several really good big investors that have investor pools of just, you know, these little communities. And there's a lot of people out there that will remain employed, and to gobble up 1 or 2 investment properties is a good recurring income for them. I think that to be a landlord right now is a good idea, because a lot more people are going to have to rent, because they might have job difficulty, you know, or be forced to leave their homes. They can't pay their mortgage. I mean, it's going to happen. It's unfortunate, but we just want to get people in the right direction, so they can get the resources that they need. We do have another question. Has the pre-approval process changed outside of the things that I've already mentioned? The pre-approval process has not changed. It's still the same. We still gather credit. We run automated underwriting, definitely super quick. But all the mechanics of the things that we go through is the same. If they're self-employed, the only thing that's really different is we can't get transcripts from the IRS for anything. And so if they're self-employed, the borrower has to go on, you can go online and get your own transcripts. So we're having the borrowers get their own tax transcripts. So that's a little bit of a deviation. The next question is also, what is your turn time for pre-approvals and pre-qualifications? So mine is the same. I don't know about other institutions. I know that other companies, from what we hear, are just still super buried. There's still a lot of refinancing going on. A lot of the bigger companies are just buried. And so we're getting a lot of those calls of people that are getting ignored, and their realtors and their friends are referring them to us. And we're fine. I mean, I just hired somebody on Monday, an additional person to help with our capacity. So you know, once I get documents from a client, we're within 4 business hours. If you need it sooner, we accommodate that. But I'd say a business day, let's just say, to be safe for us. But I'm one little fish in this very large sea. So it is lender specific. Hope that answers your question. Okay, I think I've got all the questions here. One more. Awesome. What's the fastest we can close? Yeah, here's my disclaimer to all of you borrowers and or realtors on this call. Paperwork. You've got to be good with docs. So you've got to have W-2s, tax returns, 2 months bank statements. You've got to have all that ready. If you don't want to do our secure portal where you upload it PDF, some people are technically challenged. Well, you can drop it by the office, you can fax it, go to an Office Depot and fax. Like, you have to be prepared to get us documents, because I get the pain over with early, because I don't like to make mistakes. And I don't like to get people under contract that their earnest money is at risk. So I dig early. So that's how I can close in 21 days. So if they're good with paperwork, is my disclaimer. If they're not, I will let you know and say, no, we're not closing in 21 days. So yes, 21 days is usually fine, as long as they've, we've had them pre-approved prior and we already know them. We've already got most of their documents. That's usually fine. All right. Well, if you need help, we've got here just some resources of how I'm helping people. So if you're on the call and you need your approval revisited, or whether I'm your lender or someone else is your lender, or one of your clients has another lender, if you think you're in one of those danger areas, like if you had an FHA loan approval, or even if your debt to income ratio was high, you've got to check in with your lender. I can just speak from experience. I am doing my best to proactively call those people that are in jeopardy. But the days are just super full. I'm really super trying. So I'm also saying to people, hey, reach out to me as well. So proactively reach out to your lender and say, hey, wave my arms, pay attention to me. And we definitely will. But we're also working on calling proactively those people in that danger zone as well. But you want to, just for peace of mind, I would check in. If you have a current home, if you haven't bought yet and you want to lower your payment, maybe you thought things are on hold for whatever reason, we're happy to look and see if we can lower your payment. I just locked one the other day. We saved him like $400 a month. So that was a great thing. It's going to save him some really, really good money. And people are getting cash out. So sometimes people need cash out to make improvements. I have another guy. He's taking $70,000 cash out, and when he puts $70,000 in his house, the appraised value is going to go up $150. So like just that amount is doubling for him, the appraised value. So he could sell it for more later on when he decides to sell, whenever that is. So also consolidate debt. Cash out can consolidate some high credit card debt. We're doing that on another guy that we locked last night. So mortgage relief, a couple of important things. If you're watching this, or if you have clients that you want to pass this information on to, please, if you can help it, cut your expenses everywhere else, get rid of cable, like do everything you can to make your mortgage payment. Forbearance is not forgiveness. And so if you go into forbearance, now those programs are there for a reason. I'm not saying don't apply for it, but it's not just free money to just, oh yeah, let me just skip 6 payments. Like, if you don't have to do it, don't do it, because it will create unnecessary hardship for you later on. So forbearance, you can skip 6 months payments, but at the end of 6 months, all 6 months are due. So let's say your payment was $2,000. At the end of 6 months, you have to come up with 12 grand, which is not fun. And if you don't, and say, oh, I missed the memo, I didn't know that you had to do that, they're gonna report you late. Or if you defer the loan, and again, you've got to talk to your current servicer, because every servicer is different on what they will offer. But deferment means it's tacked to the end of the loan. But then once you're out of your hardship, they're going to increase your payments so that you still pay your loan in 30 years. It's not extending the term on your loan. So again, that's not what this call was about, but just a couple of, those of you that are watching that do have a current loan, it's just really important to realize. And if you want to, just shoot me an email. You know, when I send this email out for this, just respond. I do have another email that went out to my past clients about the mortgage relief options. So if you want a copy of that, you have to please let me know. Jennifer.Hernandez@legacymutual.com, and I'm happy to send you a copy of that. Okay, that's got some more links. So I'm just going to go through some final questions. We are pretty much done. I do have another question. Can you explain the difference for retired folks in what's necessary? So yeah, we have a lot of, in fact, we got one right now that, so when people are retired and they're on limited income, there's very few resources, right? It's pension, IRA, Social Security. And then let's say we have someone that has an IRA account, and let's say they just take money out as they need it. You know, maybe they take out 30, 40,000 a year. They just take it out to meet their living expenses when they need it. So what we do is, it has to be, let's say that to qualify, we need it to be $4,000 a month. Okay. So that $4,000 a month, if we look at their average of what they've taken out in the past, it's not $4,000 a month. It's only $2,000 a month. So we'll say, hey, call your IRA person, your administrator. Let's get you on a set monthly $4,000 a month distribution. And we just have to verify that that in that one account, it has to be in one account. It can't be like all over the place. It can only be in one account that's retirement account. We have to verify that there's 36 months of that 4,000 left. So we have to forecast that you can get that income stream for 3 years. That's very important. And so the account has to have enough in it to do that. And then they just have to receive one $4,000 deposit before closing. And we use that as income because we've proven with the administrator, you know, Fidelity or whoever, that that's going to be their recurring income. They got set up on the distribution. So when we're looking at qualifying, that's how we do that. Okay. Another question. Do you think appraisers will be adjusting values down pre-values versus COVID? I don't know that yet. We haven't seen values go down yet, but I can tell you in Harvey that there was looking at that. However, it's a sign of the times. So a reason for the appraisal, and again, this hasn't happened yet. We haven't seen values go down yet. I'm still seeing multiple offers. So, but I can tell you what happened in Harvey, which was a huge gargantuan mess. What happened in Harvey is that there had to be notes made, but, you know, unfortunately in an area, there has to be trends that have to be noted. So if trends in an area are that values are going down, well, the underwriter needs to know that. So that we're just going to wait and see. So I will do another panel. You know, I'll do something, I'm sure, about appraised values as things start to become relevant, but we haven't seen that yet. We haven't seen any values go down. The other question, are mortgage companies asking to provide more documents now? No, actually. Only on self-employed that we can't get transcripts from the IRS. Well, I take that back, Dominique. Yes, we have to make sure when they're self-employed that they're still working and depositing money. So I have a guy right now, and he's I think he's a painter, and we saw his bank statement and there's no deposits. We're like, well, where's the money? That means you're not working. Like, we were suspicious that he's not working. So we're asking for more documentation to make sure that people are still employed and still depositing money. So from that aspect, yes, we're asking for more, but everything else really is the same outside of that. Let's see. Can you close a jumbo in 30 to 45 days? I don't know. I cannot close a jumbo right now, so I don't know the answer to that. So you would need to go, in the past, prior to COVID, I could close a jumbo. For me, it was 45 days. I'm sure there's, you know, when you go directly to like an Amegy or banks like that, they can probably do it a little sooner. However, they're all buried. all lenders are just buried. And so the way I'm combating that is I hired another person to help with my, my demand. And also I'm turning people away. Like when I know that it's something that I can't do, I don't want to say that I'm not working as hard to get it done, but I mean, I have to really concentrate on the clients that I can help now. So we'll forecast, we'll say, hey, this is what you need to do. This is how you increase your credit. We'll send them on their way and we'll follow up with them in 6 months. So I mean, I've got a really good qualification program to where I'm not spinning my wheels on things that I know aren't going to come to fruition right now. I'll definitely consult with them. I'm not saying that I won't. I'm just saying that this is how, I'll just tell them, this is how we do business. This is what we can do for you. It either works or it doesn't. Okay. So I don't know what other lenders are doing, but I've heard, I'll get calls all the time, like so-and-so's not calling me back. And I'm like, they're probably just buried, unfortunately. So I'm sure that now with jumbo disappearing everywhere else, these community banks are going to be flooded with requests for jumbos. And so you're just going to have to ask on a case-by-case basis what they're doing. So that was a good question. All right, I think we might have, nope. Oh, yep, a couple more questions. All right. Why are appraisers, hang on one second, I don't know what this word is. Had one of these cases, even though all agreed that the appraiser lowballed, there was nothing we can do. On appraisals, when something comes in low, what we do is we give an opportunity for the agents to provide other comps and do a reconsideration of value. We've had it work before. We've had it where values have, one time an appraiser missed a bathroom. I would give you, just make sure to always read the report to make sure you see what's in there and point out any errors. We had one where the appraiser just made a mistake on the number of bathrooms. So the appraised value did come up actually in that case. I've had that happen twice in the last couple months actually. So every case is different without getting too specific on this call, but not every lender is friendly to reconsideration of value. I mean, I guess it just depends, but I know we do that, and hopefully if the appraisers, if the value is there, the value is there. So, every situation really is different. So just make sure if you're a listing agent, you're meeting appraisers at the property with comparables and stuff. Okay, awesome. I think we're getting finished up here. My questions are dying down. I've got this last slide here that I just left up. If you look at 08 and you look at now, I mean, so far, right? Like, I don't know where we're going to be in 3 to 4 months, but things, we're coming off very, very good times. I think Houston historically, that just from what I learned in 08 and what I learned after Harvey, Houston's really good at bouncing back. People are going to redistribute. They're going to get jobs in other industries. Hopefully I'm not being naive, but we just need to all work together and keep our neighbors employed, use local services, buy local American made goods. And we need to keep doing that and hunkering down. And I'm just crossing my fingers that it's all going to be okay. But Houston has a very good mix of price ranges. And so there's a lot of lower income places where people can go and rents are still relatively reasonable. So I've got friends that are in mortgage in California that are moving. They're moving away from California because everything is jumbo, and the jumbo market is super, super unpredictable right now, and they have no business. So they're moving to another state that has a more reasonable price point, So Houston doesn't have that problem. We're pretty well balanced. Great. All right. Well, very good. Well, I think that we are at the end of this, so I am going to pass out the recording. Thank you, everybody, for tuning in. We really appreciate it. And I am always here to help. Jen Hernandez, if I can't help you, I definitely will point you in the right direction of someone that can. So thanks for tuning in.
Legacy Mutual Mortgage is an equal housing opportunity lender. The opinions expressed here do not reflect those of Legacy Mutual Mortgage.